China's economy is on the brink of outright disaster, and this is something the mainstream media doesn't want you to know about. They keep telling you that China's economy is strong, that it's turning around, but yet when you pull back the headline numbers, what you find out is something so serious is happening there that their entire economy is now on the brink of an outright collapse. And this is something Beijing has known about and tried to cover up, and even after billions of dollars of stimulus, they can't stop it. But the problem for the global economy is we're seeing what's happening in China spread into parts of Europe, and there's even hints that it's here in the United States. And what's so devastating that could send China's economy crashing right alongside the rest of the world? Well, stay tuned. This is one you're not going to believe. And plus, while the U.S. equity markets continue to push to new all-time highs, Goldman Sachs is now warning investors of one thing they're missing that could send stocks crashing. Now let's head over to China, where we picked today's story up, as China's stimulus outlook is clouded by surprise economic strength. And yet the mainstream media continues to tell us that China's economy hasn't cracked, that it's not breaking. And yet again, underneath these headline numbers you're about to see is something so serious that it tells us that China's economy is on the brink of outright collapse. But again, the risk here is we're already seeing it spread into Europe and parts of the U.S. Factory activity and construction had their strongest month of the second quarter in June, according to China's official purchasing managers' indexes. The official manufacturing PMI remained in contraction, there's a key point, but reached 49.7 from 49.5 in May. And so what happened is, again, you see what the headline media is telling you, that China's economy had the surprise to the upside, but at the same time, it's continuing to contract. Now, granted, it's at a rather slow rate here, but the key point is, despite billions of dollars in stimulus and a lot of front running of tariffs, China's economy continues to slow down. And this is a major problem because it's what's underneath the numbers that's driving the pain. But the weak employment indices put the sustainability of consumption recovery in doubt without more support later this year. And that's the problem. Despite all of this increase in production and trade to get ahead of the trade war, what we're seeing in economies all around the world is the employment data continues to weaken. We see it happen in China, where people are losing their jobs. We're seeing it in parts of Europe, particularly in Germany, and we're even seeing hints of it here in the US as manufacturers are saying, look, we're starting to lay off and we're cutting hours. And the problem is, and again, in a consumption-based economy, you need consumers to have an income so they can go out and spend. And so despite the fact that the headline number in China said there's only a slight contraction, well, if employment continues to fall, it's going to be far more than just a slight contraction. It's going to fall off the cliff. Let's turn to some U.S. data to gauge the impact of what's coming when the labor market falls out, as we look at manufacturers' new orders of durable goods against continued unemployment claims, that's shown in red. And you can see these decelerations in manufacturing activity that enter a contraction when it falls below that horizontal black line. What happens is you see a rise in unemployment. And you can see this typically happens late cycle, because mid-cycle contractions in manufacturing do not really impact the economy, as workers can find other jobs. But when you see a contraction in manufacturing and it impacts the labor market, well, watch out. But here's one thing that caught everyone for a surprise. You can see here in the U.S. data, all of this front running of the tariffs did not lead to a rise in employment. In fact, manufacturers are still looking to shed jobs here. We're seeing that again in Germany and now in China. And the risk is that everybody's waking up to the reality is that once all of this front running of tariffs is over, demand is going to plunge, and businesses and manufacturers don't want to be holding on to too many employees. So what they're doing is they're shedding jobs, they're cutting hours, and as people's paychecks shrink or go away, it means their consumption is going to go away as well. And for China, who is in desperate need to pump their economy full of stimulus, you can see why it isn't working, because workers are facing the reality that the economy there is about to head off a cliff. A tariff truce with the U.S. has led to a rebound in trade, contributing to a broad improvement in new orders for factories, builders, and service providers. But one of the things we've talked about in the past is new orders are a great gauge for employment. When new orders go up, capacity of a factory goes higher, and next thing you know, the demand for employees goes with it. So when you see new orders go up and you don't see a corresponding increase in employment, what it tells you again is everybody believes that once this trade war is over and the tariffs are set, demand is going to come plunging down right along with those new orders, and again, the need for workers. And at the same time, sales prices are continuing to drop despite narrowing their decline across the sectors. What's more, manufacturing employment weakened in China, illustrating the weakness of domestic demand and the vulnerability still lurking in the labor market. So what we're actually seeing here is inventory building. And the great thing about inventory building, it pumps up the headline number. It makes things like GDP look fantastic. But again, if you don't have people working, they can't consume. And then the risk is you start to see this inventory build up, and if it doesn't move, well, then what happens is price pressure starts to go down. So again, the media wants you to believe that things in China are turning around, but if you look at the fact that they're still seeing disinflation and deflation and a decline in demand, not to mention a decline in workers, well, what it's telling you is their economy is weakening fast. It's on the edge of an outright collapse, and again, it's spreading all across the world. And we can see the effects of inventory building. Let's take a look at advanced retail sales. This again, U.S. data in blue against the consumer price index in red. And when retailers get too much inventory and consumers pull back, what you find out is retail sales start to decline, and then inflation goes with it as retailers look to cut price of inventory to move it, and that goes all up the supply chain. And you typically see this late cycle, but not always. You see it happening going into the dot-com bubble, the global financial crisis. But what happened here around 2012? Well, again, we were headed into a globally synchronized recession. U.S. consumers pulled back, inventories were too big, and next thing you know, disinflation took hold. But look at where we're at now in the U.S. We saw a surge in buying ahead of the tariffs, but what happened? We see the consumer price index continue to trend lower. So broadly speaking, we know what's going on in the manufacturing sector. We know why these headline numbers look so good. The issue is the media wants you to believe that everything's okay, but underneath, consumers are telling you things are not going well. Workers are afraid of losing their job. And what that means is spending is plummeting all across the world. And this is a self-fulfilling cycle, my friends. Once people pull back on their spending, watch out. It means things are going to spiral out of control. Owning gold is often talked about during times of economic uncertainty. While some choose to hold gold to diversify their assets, there are other options to make your gold potentially more productive. Monetary Metals presents an opportunity to turn your idle gold into a productive, yield-bearing asset with the potential to pay you more ounces of physical gold every month. The income is earned in gold, not dollars, not IOUs, but actual physical gold deposited into the account every month. The approach allows gold owners to potentially generate yield while retaining ownership. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. There are risks to any investment. Risks of leasing gold include but are not limited to loss of gold principal from leasing to Monetary Metals and other counterparties, shipping, or any other time gold is in transit. If you purchase gold through Monetary Metals, you may pay up to 0.75% over spot price. Additionally, the price of gold may experience a substantial loss without assurance of rebounding. This is not a recommendation. Before making any investment decision, it's crucial you conduct through research, understand the terms of participation, and assess potential risk. Go to monetary-metals.com/Stephen to learn how you may be able to start earning a yield in physical gold and silver today. Again, that's monetary-metals.com/Stephen. Persistent deflation and weak consumer demand have shadowed the economy throughout the trade war, again, providing evidence that all this government stimulus and rate cuts, they're not working. They don't have an effect because, again, when consumers start to realize that their income is going down and they start to cut their spending, no amount of stimulus seems to help. Property prices are struggling to bottom out, which is a major issue in China, weighing on household wealth and confidence, and that's because about 70% of Chinese wealth is held in real estate, and if prices go down, well, it's the same effect for U.S. investors if the stock market goes down. When people feel they're less wealthy, they tend to spend less, particularly if prices continue to fall, they cut back in a major way. And the value of new home sales from the 100 largest property companies stood at 339 billion yuan. That represents a 23% fall from a year ago. And we already know that as sales go down, prices go down. But again, there's a self-fulfilling prophecy going on in China here that as the global slowdown starts to hit and all this front running of tariffs and inventory building comes to an end, the demand for labor is the key indicator here because, again, as employers start to cut jobs, well, watch out. You're going to see a lot of things spiral down. Let's take a look at, again, U.S. data here to get a gauge of what's happening in China's property market. Let's look at new privately owned housing units started in blue against manufacturers' new orders of durable goods. That one's shown in red on a year-over-year rate of change. So as housing starts go down, the demand for durable goods goes down with it. And you can see this happen here again, going into the dot-com bubble and other cycles. So I want you to see the correlation of what happens here in the US and what's going on in China. As sales of new homes go down and prices go down, well, the demand for goods to build all of these properties goes with it. That impacts China's manufacturing sector, leads to hours getting cut, leads to jobs getting lost, leads to people losing their confidence because their wealth is dropping. And next thing you know, spending continues to collapse right alongside the economy. And again, what's holding everything up right now is all this front running and inventory, suggesting that something happening in China that could push it right off the cliff. And soon. And we see this relation between housing starts and new orders throughout every cycle, but despite the fact that we saw an increase in new orders here, it did not translate into the housing market, meaning, again, it's all front running of the tariffs. And let's look at the impact as housing starts go down, what it means to the labor market. And China's economy is not immune, because when builders cut production, they cut the demand for labor. You can see this throughout every cycle. Housing starts plunging. Next thing you know, continued unemployment claims in red head higher. And you can see the bottom of continued claims here in the US match the peak in housing starts. So as the employment sector in China continues to fall apart, the demand for new homes is going to go with it. And that means, of course, construction jobs, along with a lot of other jobs tied to the housing market. But again, this isn't something that's unique to China. We're seeing this happen here in the US and other parts of the world. As the economy slows down, the risk is we could see a housing recession, particularly as we note here in the US. Builders have built a massive amount of homes. They're seeing the largest inventory since the global financial crisis. At some point, they're going to need to clear that out. And if buyers don't step up and soon, what it means is they're going to cut jobs, they're going to cut production and building. It's going to impact the US manufacturing sector as well. So what you can see is happening in China, again, spreading all across the world. We know it's happening in Germany's manufacturing sector because they export a lot of goods to China. We can see the same relationship in our housing market as what's happening in China, but the issue here is the same as well. We're seeing a lot of manufacturers front running in terms of building inventory, and they're soon going to be cutting jobs. Let's turn to Germany, where we continue today's story as their inflation, quote, unexpectedly cools to match the ECB's 2% target. So once again, the mainstream media baffled by why inflation's going down. But we've told you why this is happening, because once you see growth turn down, inflation is a lagging effect. It does follow right along suit. But this is baffling because what's happening in the European Union, they're cutting rates. And everybody says rate cuts are inflationary. We say they don't work if people don't have a job. And officials look to set a timeout from lowering interest rates when they meet next July. The ECB is to cut its deposit rate 8 times since June of 2024, leaving it at 2%. And so here, this makes absolutely no sense. They're going to pause cutting rates at a time that the European economy continues to decelerate. In Germany, the manufacturing sector has been in a depression. Now, it's improved somewhat, meaning it's not contracting as fast as it did before, somewhat similar to what's happening in China. But the risk is a lot of people in Germany have seen their hours cut. They're seeing their jobs lost, and there's risk that more people will. And the response of the ECB is, look, we've cut a lot of rates. We're worried about inflation. Inflation didn't happen. And not only that, now they're going to stop cutting rates, stop providing any support for the economy. And all of this validates is once again that rate cuts don't work, and the mainstream media remains completely baffled. But let's take a look at why they don't work, because what's happening in Germany, again, is manufacturing sector is plunging. Let's take a look at what happens when durable goods new orders, that's shown in blue, go down against the consumer price index. Again, this is U.S. data, but you can clearly see that most of the time, and not every time, you see inflation come down with a lag, because as manufacturers cut production, what happens is you see consumers are cutting their spending, and inventory has to get worked through, and next thing you know, inflation turns into disinflation. And sometimes, like the global financial crisis, you get outright deflation. But what's notable here, and again, we look at this front running of tariff effect, all this inventory building is clearly seen right here. Durable goods new orders up, but it's not because consumers are spending. That's why inflation continues to trend down. And so once again, you see the mainstream media say, look, we don't understand why inflation is going down. It's very clear, because the global economy is continuing to slow, consumers are spending less, and what you're seeing in the headline data is a lot of inventory building, front running of tariffs. And as soon as that goes away, you're going to see the demand for labor go right along with it. And this is in part what Goldman Sachs is warning investors right now who are chasing equity prices higher to new all-time highs, thinking they could only go up from here. But as earnings season kicks off, Goldman says the worst is yet to come. As U.S. profit margins face key risks from tariffs, as Goldman strategists warn. And here's the thing, investors want to see massive profit margins because that's what drives equity prices up. But at the same time, consumers have been demanding that companies absorb those price increases, which a lot of companies have been doing. So there's an issue here. If stock prices are going to go up, it's either due to margin expansion or because companies are profitable. But the reality is, if you're seeing companies eat a lot of these tariff increases, it tells us that investors are chasing margin expansion, and when that happens throughout history, it means things at some point are going to come plunging to reality. And while most of the added costs are expected to be passed on to customers, so far they haven't been. The corporate margins will be pressured if companies are forced to swallow a larger than expected share, and that's something we continue to hear from companies like Walmart and Target, and even the automobile manufacturers say, look, we know our customers can't afford higher prices, but at the same time, because stocks are breaking out, everybody wants to play chase, and that's a major problem. Because corporate earnings have proved robust so far, but a sharp slowdown in U.S. profit growth for the second quarter could derail everything. And right now, data suggests that profits are only going to rise 2.6% for the April to June period, the smallest increase in 2 years. And yet, from investors' perspective, stocks are only going to go higher. They're going to chase them higher. And yes, we said this a while back. Remember over a month ago, I said there could be a massive short squeeze that drove equity prices up because people would play chase. Now, the issue is people look at the stock market and say it's a proxy for the economy. But when you look at what's happening in China, you look at their manufacturing sector, their real estate sector, and you look what's happening in Germany and here in the U.S., you can see there's a massive disconnect, one that's so big that the stock market is often the last to find out. Let's take a look at corporate profits after tax in blue against the NASDAQ 100 in red to get some perspective on what Goldman's warning about. Let's look at the late 1990s. This is a perfect example. You see the NASDAQ 100 surging higher as investors chase margin expansion and rising prices. At the same time, corporate profits are in contraction. They come out of that briefly only to re-enter it, and then next thing you know, the stock market has a reality check. You see the same thing happen going into the global financial crisis. You can see blips of this around 2015 and in 2016. How about around 2018? You see it happen in 2022. And so we know profits are likely to continue to decelerate in the quarters to come, perhaps even contract. And for equity investors that are now clearly chasing margin expansion, the risk is very high. There could be a major day of reckoning. And if the global economy doesn't turn around, and this is a risk that I want you to see, the media is covering this up. They don't want people to know because the wealth effect is real. And if you as consumers continue to feel wealthy because stock prices go up, they may go out and spend. But if they don't, and what's happening in China and Germany, and is starting to happen here, starts to take hold, and watch out, a bear market's going to be the least of our problems. We could be facing an all-out global financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.